Basic technical analysis. While support and resistance are a good basis for various technical analysis studies, these concepts can evolve into variations including trend lines, channels, and Fibonacci retracements. A trend line is a joining line that is drawn between the rising highs or decreasing lows. It is often accurate to predict support or resistance. As you can see on the chart, the trend line can be drawn to connect multiple points on the chart to predict the uptrend. The more points that you have connected in the line, it is usually a stronger indication of the validity of the line. Trend lines are used as trading tools in one of two ways. One can either trade the bounce off the line, or if the trend line is broken, it will usually indicate a trend reversal and a large price movement in the other direction. Trend lines are used in a similar fashion as support and resistance. However, the main difference is that they will help predict higher highs or lower lows. Just like with support and resistance, the longer the time frame on the chart, the stronger the levels are. Channels are a range between support and resistance levels that a currency price has traded in for a specific period of time. Channels are horizontal or can be diagonal, up or down. No matter if the channel is horizontal or diagonal, you need at least 2 points on each side for the channel to form. As you can see here, the price touched both support and resistance 4 times to form the channel. A channel can be traded by selling at resistance and buying at support, or waiting until one side of the channel is broken as seen in the chart and placing a trade to ride that price movement. Diagonal channels are referred to as ascending or descending channels depending on the direction of the trend. As you can see here, the trend is going down, so we have a descending channel. In this next example on the chart, the trend is in an upward price movement, so it's an ascending channel. Fibonacci retracement is a term that refers to the likelihood that a currency pair will retrace a large portion of an original move and find support or resistance at the key levels before it continues in the original direction. Fibonacci retracement is created by taking a swing high and a swing low, which are extreme points on the charts, and dividing the vertical distance by the key Fibonacci ratios of 23.6%, 38.2%, 50%, 61.8%, and 100%. Once these levels are identified, horizontal lines are drawn and used to identify possible support and resistance levels. When the support and resistance levels are in place, you can then trade these accordingly. Traders will use these lines to predict price moves, place profit targets, or stop losses. If the 100% level is broken, this is considered a full retracement. At this point, you will look for a new swing high and swing low to draw a new Fibonacci retracement for the upcoming market movements.